welcome to the Deep Dive. Today we're jumping straight into BlackRock's Q3 2025 results. Massive numbers, big acquisitions.
Absolutely. And the mission today is quick. Unpack these earnings, especially the difference between the official GAAP and the adjusted numbers, and figure out what the huge flows and strategy moves mean for, well, for you.
Okay, let's tackle that confusing part first. The headline GAAP number, the diluted EPS, it looked rough. Down 23% year over year, $8.43.
Yeah, $8.43, which on its own looks like a big red flag, but you've got to look right past it, really, to the as-adjusted number.
Right.
That came in at $11.55, which was actually up 1% year over year.
Okay, so that's a massive swing. Down 23% versus up 1%. What's the story there? Is it just accounting noise?
It's significant noise, yeah. It's mostly non-cash expenses tied to the big acquisitions. They just think GIP, HPS, Preqin.
Amortization and integration costs.
Exactly. Stuff like amortization of intangible assets. It hits the standard GAAP bottom line hard, but it doesn't really reflect the day-to-day fee generation of the business.
So the adjusted figure strips that out to show the core operation.
Pretty much. And that core operation looks, well, pretty healthy. Revenue was up 25% year over year.
Wow. To what level?
$6.509 billion. And the adjusted operating income, up 23%.
Okay, so that adjusted view suggests the actual business of managing money is accelerating, even with all this M&A activity.
That's the message. And Larry Fink, the CEO, he basically said they're heading into Q4, which is usually their strongest quarter, with, quote, building momentum and a fully unified platform.
Building momentum, right. Let's talk inflows. They reported $205 billion in net new money this quarter.
Yeah, described as one of their strongest ever. It's a huge number.
What does that translate to in terms of growth?
Well, those flows alone powered 10% organic base fee growth just in Q3. That's, growth from their core business fees.
And the overall assets under management, AUM, must have hit a new record.
It did. A new high, $13.5 trillion. Just an astronomical figure.
$13.5 trillion. And that scale comes from diversification, right? They hit some big internal milestones, too.
They did. Two really notable ones. iShares, their big ETF brand, crossed $5 trillion in AUM. Record demand there.
$5 trillion just in EPFs.
Just in iShares, yeah. And at the same time, their cash management business, Think money market funds, that crossed $1 trillion in AUM. So safety and market exposure drawing assets.
So that $205 billion inflow, where did it go? Was it all just piling into index ETFs?
No, actually. It was pretty broad. ETFs were the biggest chunk, sure, $153 billion.
Okay.
But fixed income also pulled in $47.5 billion, and cash management got $34.1 billion. Fink also pointed out strength in areas like systematic active equities, private markets, even digital assets, and outsourcing.
So they're firing on multiple cylinders.
Seems like it. They're managing to attract money across the board.
Okay, speaking of private markets and acquisitions, let's link that back to the revenue. That $6.5 billion revenue figure includes the new businesses, right?
Oh, definitely. This wasn't purely organic growth on the revenue side. The HPS Investment Partners deal closed July 1st, added $165 billion in AUM right away.
And started generating fees immediately.
Exactly. In Q3, the results included about $215 million in fees related to GIP and around $225 million related to HPS. These deals contribute significantly from day one.
And strategically, the big push is in alternatives, private markets. How did that look?
Huge growth there, largely thanks to the acquisitions. Alternatives client assets basically doubled year over year. They were $334 billion in Q3 last year. Now they're $663 billion.
Wow. So the strategy of combining public and private is gaining traction.
It is, but the key to making that work, especially at scale, is data. And that's where the Preqin acquisition comes in.
Right, the private market data company.
Yeah, they're plugging Preqin's data right into their Aladdin and Affront risk management systems.
Why is that integration so important, maybe for someone listening who isn't deep in institutional finance?
Because BlackRock's aiming to eventually bring these private assets, which are less liquid, into more mainstream portfolios, maybe even 401ks down the line. And Fink knows to do that, especially under fiduciary rules, you need rock-solid data, really transparent analytics to justify it. He basically called this integrated data system the engine that powers the whole thing. It's about building the justification.
But bringing private credit mainstream, that also brings risk concerns. Fink got asked about some high-profile bankruptcies, like Tricolor and First Brands.
He did, and, he acknowledged those specific failures, mostly in asset-based lending, but he argued the overall credit quality across their wider portfolio is actually getting better.
So how did he frame those failures?
He kind of used them as an example of capitalism working, saying failures happen and the market eventually roots out bad underwriting. It's a necessary part of the process, in his view.
But there's a tension there, isn't there? For the average person being asked to maybe trade some liquidity for potentially higher returns in private assets.
That's absolutely the core issue. Fink constantly talks about the power of compounding. That extra 0.5% return over 30 years means, 15% more in your retirement pot. It's a big number.
And the bet is that their tech, the Aladdin Preqin engine, can manage that risk.
That's the bet, that superior data and analytics can help them pick the winners and manage the inherent risks, like liquidity, that come with private markets.
Okay, technology. That leads us to the next big bet, digital assets and AI. What's happening on the digital asset front?
Well, the momentum is certainly real in terms of AUM. Digital assets under management crossed $103 billion.
Over $100 billion.
Yeah.
And that's mostly the Bitcoin ETF, I bet.
Yeah, the iShares Bitcoin Trust IBIT is the main driver there, already over $100 billion itself. It's been a phenomenal success and kind of validates their push into this space.
But Fink sees Bitcoin as just the start, right? He talks a lot about tokenization.
He does. He really seems to believe tokenization is the next big transformation. The idea is that eventually almost any asset, real estate, stocks, bonds, could be represented as a digital token on a blockchain.
And the goal isn't just efficiency.
No, it's also about access. Digitizing traditional assets makes them potentially easier to integrate into the digital ecosystems where, maybe younger investors are starting out. It's a bridge.
Interesting. Let's shift to AI. That's driving huge investment across the economy. And it's showing up in BlackRock's tech revenue, too.
Yeah, their technology services revenue, which includes subscriptions to things like Aladdin, was up 28% year over year. That's a strong growth engine for them.
And that's selling their tech to others.
Exactly. Even if you strip out the effect of the Preqin acquisition, the underlying annual contract value, or ACV, for their tech services still grew by a healthy 13%. They're successfully monetizing their internal tech platform.
Fink also made an interesting point about labor productivity related to AI.
He did. He noted BlackRock is growing faster than the growth of our headcount growth, meaning they're scaling up assets and revenue without needing a proportional increase in staff.
So AI is augmenting their workforce, making them more efficient.
That's the idea. Using tech to enhance what their people do, not necessarily replace them wholesale, allows them to manage more complexity and scale.
He also threw out a huge number for the kind of capital investment needed for the AI infrastructure build-out nationally.
Yeah, a really eye-popping number. He estimated something like $1.5 trillion is needed just for data centers and the power grids to support them in the U.S.
$1.5 trillion.
And he framed it not just as tech spending, but almost as a matter of U.S. geopolitical competitiveness and necessary generational investment, even if some specific projects fail.
So investors seem to be buying into this strategy. The stock hit an all-time high recently.
It did. Mid-October, BlackRock stock touched $1,184.14. It's been on a strong run, up over 31% in the last 6 months alone.
And analysts are positive.
Seems so. We saw BofA Securities keep a buy rating, lifting their price target to $1,394. And BMO Capital started coverage with an outperform rating and a $1,280 target. They specifically mentioned the potential from integrating GIP and HPS.
So the market's betting on that integration going well and the overall strategy.
Yeah, and it all ties back to Fink's core message, which is relentlessly focused on the long term.
Compounding, not trading.
Exactly. Stay invested, diversify, use both public and private markets to try and capture that extra bit of return, because over decades, like he says, that extra 0.5% adds up to potentially 15% more for retirement.
So summing up Q3, it looks like success driven by integrating these big private market acquisitions effectively, which boosts revenue immediately, combined with placing these big bets on future tech like tokenization and the AI infrastructure boom.
Right. They're investing heavily where they think the economy is going, not just where it is now. And interestingly, Fink ties this directly to the biggest risk he sees for the U.S. economy.
Which is?
The national deficit. He flat out said the greatest risk is the deficit, and the only way to really manage it is if the U.S. economy grows at 3% a year consistently for the next decade.
And he sees private capital investment, like the kind BlackRock is facilitating for that $1.5 trillion AI build-out, as the key to hitting that growth target.
That seems to be his argument. that unlocking private capital for these essential infrastructure projects is crucial to generating the kind of economic growth needed to overcome the deficit challenge.
Okay, so that leaves a really interesting question for you, the listener, to think about. We see this massive wave of private capital, guided by firms like BlackRock, pouring into AI infrastructure and other areas. Fink argues this is key to hitting that 3% growth needed to tackle the national debt. Is that CapEx boom enough? Does it actually guarantee we hit that 3% target, or is it just one necessary piece of a much larger puzzle?